We're seeing a profound change in the world monetary order that is reflecting the change in the world economic order and political order. Namely, it used to be the United States was dominant, and the rest of the world doesn't want to have the U.S. be able to control its finances through the U.S. dollar. And the only alternative really is the gold.
Hi there, I'm Liz Thomas, Head of Investment Strategy at SoFi, and this is the important part. How do you spot an investing trend before anyone else? You can start by asking Jan van Eck. Jan is the CEO of VanEck, one of the world's largest providers of ETFs and mutual funds. So you can say he's got a little bit of experience at that. His firm pushed for a Bitcoin ETF years before the regulators allowed it. His family launched the first gold fund in the late 60s. And Jan is here today to share the family recipe for trend spotting and how you can apply it to your own portfolio. Jan, thank you so much for joining me.
Oh, it's great to be here, Liz. I look forward to our discussion.
Okay, let's start with gold because that's such a hot topic right now. And by the way, nothing in this episode should be treated as a recommendation from SoFi, and it is not investment advice. But let's set the stage here. VanEck has the gold miners ETF.
Right.
But I want to talk about gold as an asset class right now, just by itself. And I honestly think it might be an asset class by itself right now. It falls into the precious metals category, but it's had such a good run. So performing so well, even compared to the S&P, which is not normal, right, over history. How long do you think that continues? So far in 2026, it's still happening.
Yeah, well, I think it can happen for up to another 10 years or so, Liz. Very, very bullish. I think what you're seeing, we tend to look at long-term historical trends in terms of trying to inform our outlook. And because actually, if you look at history, the world changes dramatically in terms of how it changes, and then also it changes very fast.
Yeah.
And so I think we're seeing a profound change in the world monetary order that is reflecting the change in the world economic order and political order. Namely, it used to be the United States was dominant, and now in the next 10 years, India will sort of join China in terms of being a super economy, if you will. It's going to be the size of continental Europe. So the U.S.'s share of GDP is just smaller and smaller, and the rest of the world doesn't want to sort of have the U.S. be able to control its finances through the U.S. dollar. And the only alternative really is the gold.
So 10 years. Today, as we record this is January 21st. Gold is still under $5,000. Are you in the camp that it hits something above 5,000? What's that 10-year market like?
It's hard for me to kind of price target, and also the good thing about long-term trends, Liz, is I don't have to worry about getting the projection right in the next quarter or 2026. Because really, in the short term, who knows? I think over the next 10 years, I think it could go, yes, definitely above 5,000. We're almost there. 10,000, even higher if these current trends continue.
Yeah. So I mentioned in the intro, your family started the first gold fund in the 60s. That was when the price of gold was fixed at $35 an ounce.
Right.
So let's talk about that. And to the extent that you have knowledge of it, why? Why did that happen? Why did they do that? What did they see in the market at the time that made that such a good opportunity?
Right. So the old world used to be centered around the gold standard. And I don't think, I didn't even understand what the gold standard was until recently. But basically, think of all of financial institutions as Jan and Liz setting up their own bank. And other people would say, well, I don't trust Jan and Liz, right? Why should I trust them with my money? And we would say, well, look at our vaults. We have a lot of gold, right? Because really, they don't know what we're doing with their money. And then that became true for governments as well. So all the European countries, the United States, when we got wealthy, we'd buy gold to show people, well, we're trustworthy. There's something there. Because in the early days, governments didn't bail out banks. Even states went bankrupt, right? So gold is just reverting to that role as the number one world's currency, because basically these days countries, if the U.S. disagrees with them, and it seems like we're not going to seize their assets, right? So that's basically, I think, reverting to that world of 100 years ago. Then, okay, to your question, what happened in the 1960s? Basically, everyone started trusting the dollar without a gold backing per se. And then we started printing a lot of money in the 1960s. And so my father said, listen, you're not going to be able to maintain your value against gold when your value of paper is going like this and the amount of gold you have isn't changing. And the market isn't going to accept that. And so, correct, the gold was linked to the dollar for a long period of time. It didn't change at all. And the prediction was that link is going to break. And 3 years later, it did in 1971. Wow. And then gold went from $35 to $800 an ounce in the 1970s when we had all these inflationary issues.
So today, the dollar and gold are not linked, right? At least not explicitly, right? But they have relationships, generally speaking. So would you say, you've kind of mentioned that maybe there are parallels now to what happened back then with nations around the world not trusting the central banking system, maybe not trusting where to put their reserves. So we're reverting to gold as the only option there to sort of get it away from the dollar. And there's been now a few years, ever since I would argue Russia invaded Ukraine, where the dollar got weaponized. And I think nations around the globe saw that happen and said, oh, no, not us, right? We don't want that to happen to us. So here we are with gold having this epic run. Would you say then that the dollar is not trusted anymore? And because there's this constant fight that goes on. It heats up every 5 or 6 years and then it dies again. And it's that the dollar is no longer going to be the global reserve currency. It's going to go away, right? It's changing, but it never really does. So is that actually going to happen this time?
Well, there are a lot of things happening, and but I do agree that gold can go up and the dollar still be an important currency in the world. I really think we need to decouple what's happening in the United States with the fact that the world wants gold as a global currency, because people used to say like we have inflation in the 70s. That's why gold hit record highs in the 70s. Forget inflation. Like gold hit record highs last year and inflation came down.
Right. So let's talk to the retail investor a little bit here, because the way that the retail investor can access something like gold is through ETFs. Right. ETFs like GLD or IAU. They can't, I suppose they could go buy physical gold, but generally speaking, it's through ETFs. The VanEck ETF for gold miners, ticker GDX, that gets lumped into that category a lot, right? A gold ETF. But it's different, and it acts differently than the actual gold ETFs do. So if you're talking to a retail investor, how would you tell them to use something like a gold miner ETF versus a gold ETF in their portfolio?
As a complement, I'd start with gold bullion, and we have an ETF in that area as well. But miners, it's great in an upcycle. The miners were up something like 150% last year. Right. Gold was up 60%. But in a down cycle, it's way worse. So from 2011 to 2016, gold shares went down 90%. So part of that is they're not great businesses. They're not finding a lot of gold these days, the mining companies. But basically, I would say, first, do I want to own gold? And those are the conversations VanEck loves to have with investors is, what are the asset classes in your portfolio? We think that's the most important question. We definitely think that this is a good time, and I'm not always advocating for gold, by the way, but we do think this is a good cycle for real assets and for gold, and then gold shares and silver, which is kind of a bonkers asset.
Parabolic.
It's like the Bitcoin of 2026, right? Those are complements to a core gold holding in our portfolios.
You've said before that there are some parallels between Bitcoin and gold. I want to dig into some of that in a few different ways. First of all, there are some investors, not all, that would call Bitcoin a store of value. I think there are many investors that would call gold a store of value. Where do you fall on that? Are they both a store of value, and should they be treated that way by investors?
So they're both limited in supply. So I would say that they are both stores of value in my mind, right? I definitely think algorithmically that's how Bitcoin is designed, and gold, just because of the force of nature, its supply doesn't increase a lot. So I do think that's the role they play in people's portfolio. I would say the other aspect of that, they don't pay dividends and they don't pay interest. And there's some investors, I always like to point out, like Warren Buffett, who doesn't like Bitcoin or gold, right? They just think store of value assets are not important in people's portfolios. You pointed out their performance can be good, and we think their diversification is really important in portfolios.
Well, and what's happened in Bitcoin, I think this recent period where Bitcoin has seen so much volatility, and again, as we're recording this on January 21st, the last time I checked, Bitcoin was somewhere in the 87,000 range, and that's down from 97,000 about a week ago. Gold hasn't seen drawdowns like that recently, right? So the behavior of them is so different that I think that's where investors start to struggle. If they look at both of them and say, okay, I'm treating each of these as a store of value, but this one is moving completely independently from the other, and on things that I don't even entirely understand, how do you set expectations for something like Bitcoin through different environments?
Bitcoin and gold, I think to a certain extent, are like currencies or bonds or some other asset classes that actually can change how they behave in different economic environments. So basically, my whole story about gold is one fundamental change. We're in a new paradigm, and we're in a world that's more diversified, and they want gold. Bitcoin is kind of I describe it like a teenager. It goes through these different phases.
Moody.
It goes through different phases of growing up. So the phase that it's in right now started since COVID, where its correlation to the NASDAQ is much higher.
Right.
So right now it's behaving like a risk asset, like stocks and bonds, basically, right? So yeah, Bitcoin is selling off. And so that is not as desirable to me, because I'd rather have something like gold that went up yesterday and everything else went down. I want something that Bitcoin used to have a zero correlation against everything else, but it rose during COVID. I hope it grows out of its teenage years. That's my hope, because otherwise it's a little bit compromised, right? It adds a little bit less value in your portfolio if it just follows the NASDAQ, which a lot of people have exposure to already.
And you've said recently that you'd like to let Bitcoin rest for 3 to 6 months. Do you think it's going to become a 20-something in 3 to 6 months? It's out of its teenage years, or is that just a bout of volatility that we're in? What's the magic of that time frame?
One of the first things you learn about Bitcoin is that supply is limited. The second is every 4 years, right, the miners that run the network get paid half of what they used to get paid. Okay. And that has caused this 4-year cycle in Bitcoin where 2026, like 2022, it should be underperforming.
Oh,
for the first time, it was supposed to, again, by the cycle, go up in 2025. Instead, it went down. And so this 4-year cycle was broken last year. Okay. It was of major asset classes, it was the worst performing. So the 4-year cycle is broken. And I think a lot of people were just selling in advance of this 4-year cycle, which would have been this year, right? It makes sense. If you think it's going down in 26, sell in late 2025. So I think, again, it's that part of whatever Bitcoin was, it's not going to repeat it as it gets older and more mature as an asset.
Okay.
If that makes sense.
It does. And that's interesting, actually. I hadn't thought about that before.
And that's why I give it a break, because it's time to have its 4-year annual pause in terms of negative performance. And, there are a lot of theories out there as to what's going to happen this year with Bitcoin, but I think we look at it as sort of making a bottom. And if you like it long-term, which we do, it's time to buy selectively. Sure. I just kind of say things don't turn around in a month, Liz, right? So if this year is a bad year, and maybe even if the year started in September, we still have time.
Right. Well, and bottoming is a process for any asset.
Exactly.
It happens over time. You find double bottoms, right? It sort of grinds sideways at the bottom for a while before the bottom has actually been found. And of course, you can always find the absolute bottom, but usually it takes a while. Do you think that the investors buying Bitcoin are the same investors as the ones buying gold?
So one of the things that attracted me to Bitcoin actually in 2017 was a lot of our gold investors who loved speculative small cap gold stocks were buying Bitcoin instead because Bitcoin was giving them a better return. So there was definitely an overlap. Like they got store of value investing. They're like, I see this. This is my kind of asset, right? However, like there are big generational differences now, I would say, in the Bitcoin community. We keep adding. So certainly, younger people in their 20s and 30s, like this has been proven time and again, right, are much more attracted to digital assets than your traditional gold investors. So demographics wise, I think that's definitely true. I just think, the thing that's astounding to me and why I'm bullish gold, American investors are still not that interested in gold, even though it's performed so well over the last several years. We had net outflows out of GDX last year. So really what I think was happening is people stopped being negative, meaning they were covering their shorts, which isn't a complicated dynamic, but that was it. Like I didn't see, there wasn't a ton of money going into gold or gold share ETFs. The rest of the world's obviously buying actively, but US investors are asking themselves, did I miss it? And that's like, did I miss Bitcoin? And then it's very hard to get them to say, no, you don't have to buy your full 1% or 2% today. Just buy $20 worth. Get over that psychology, right? But when it's going up at 1% a day, people are psyched out. And that's a big problem in the stock market too, I guess, right? We hit all-time highs and people are like, oh, I can't buy at the top of the market. But
that's investor psychology, right?
That's your job.
Right. Well, and you pull up a chart and it's like, well, I look at this chart going from, the bottom left to the upper right so fast. How could I enter now? Okay, you're bullish on gold. You said this could go on for 10 more years. And you've been quoted recently saying that you think Bitcoin can get to $2.9 million per coin by 2050. So pretty bullish Bitcoin over the long term. 2050 is a long time away.
Yeah.
And I realize both of these are long-term strategies. So I'm going to ask you maybe an unanswerable question, like your favorite child. Are you more confident in gold or in Bitcoin?
Over a 10-year period?
Sure.
It's a close call.
Yeah.
By the way, 2.9 million was a speculative number by one of my colleagues, but I do think, I haven't sold any Bitcoin, and I think it will continue to kind of mature and evolve. And you see that with the ETF adoption and things like that. So I think at some point it could catch up.
That's wild. I remember when we were talking about 50,000 being a crazy level for it to get to, and then 100,000 was a crazy level. So if we get into the millions.
But the starting point changes everything, right? If it's close to $5,000 an ounce for gold, it goes to 10, that's only doubling.
Right. Okay, let's transition into some macro stuff because you've called VanEck a macro shop before. What do you mean by that?
Thanks for asking. When we talk macro, I will talk about the big things that affect the stock market. I'll talk about politics. I'll talk about technology like AI. I'll talk about government spending and money supply. I think you can get very excited about these very big picture trends like the development of Bitcoin, right? It was $3,000 a coin when we started getting involved at VanEck. So the rise of China. Some of the biggest things that happen in the world that create new asset classes,
right?
And that's what gets us kind of excited, and that's what we look for, because it won't help necessarily with 2026, like we've been talking about with gold, but it will help for your overall portfolio construction. I think to take a big step back and say, wow, this is really at a real historical extreme, not like a 1 month low or something like that. That's basically just noise in people's portfolios.
So if you could give an investor, not everybody has an ETF shop that they have tons of people looking at this every day. If you can give the average investor some ideas for how do you start to spot things like that and think about, I'm seeing all these news headlines and I think that's one of the benefits, but also one of the drawbacks of being an investor today. So much information at our fingertips, everything is available, but all of it seems like we're supposed to do something about it.
Right. Well, we try to have a dialogue with like this discussion today. We try to talk to clients. We publish quarterly outlooks where we kind of try to identify these trends. I would say from the ETF industry perspective, when we started 20 years ago, a lot of indices or the way the market was measured just was from a newspaper or from academics. They weren't really how people think about investing. So even gold shares, there wasn't a gold share index. There were gold share indices, but none that was diversified enough to create an ETF. Some basic mining things that, they just weren't like an industry the way you think about it. I'll pick a recent example, which is asset managers of private credit and private equity funds, right? That wasn't, we just were able to launch an ETF on that last year because enough of those companies had gone public. 10 years ago, that was an industry that didn't exist. And, the major index firms didn't necessarily have an index that tracks it. So I guess my point is, if you just look at the number of companies that are out there and the industries that spring up, it's pretty and sometimes.
Do you ever find out that you're wrong about a trend? And then how do you know that you're wrong?
Well, I would say there's two things. Some trends take forever to work out.
Yeah.
So I can give you two examples. One was we launched a Vietnam ETF, and there weren't enough stocks on the local market, so we had to include some neighboring countries in that index. Okay. And that took maybe 5 years to work out. Okay. I was expecting 1 year. Okay. Nuclear, we launched the nuclear ETF a year or two after we started our business, so like 18, 19 years ago, because we just said, listen, it's 20% of electricity generation in the US. It's an industry, right? So it can fit into a category. And we think eventually the politics will change on it. We were way late, right? It took 15 years. And that ETF, as one of my colleagues likes to point out, was less than $20 million in assets in 2020, 2021, 2022. Now it's almost $3 billion.
Oh, wow.
So it just takes time.
Never wrong, just early.
That's a generous way. That's a generous way of putting it.
Yeah.
In terms of our quarterly outlooks, probably frequently wrong, but frequently right as well. So our track record is too young on that.
We all are, and we have to admit it too, right? You have to be able to look at your own batting average and say, "Whoa, was I wrong on that?" Right? Or I was a couple years early, or whatever the case may be. It doesn't really matter if you're early. If you're early to the investing public, you're wrong. So it's humbling to put out any type of outlook and try to make a call even a year in the future, let alone 2, 3, 5, 10 years in the future.
One of our fundamental, business philosophies is when you talk to investors, talk to them about the upside and also talk to them about the downside. And there's nothing worse than talking about the potential downside and it not happening, like federal budget deficits and debt, right? But you have to include that, maybe not in this podcast, but you have to include that in the conversations because investors need to know what those risks are.
Right. Well, and especially the risks we know about. Right. You have to tell, here are the risks we know about that could become a problem. Here's how you can understand them so that maybe if it does occur, you can see it coming or as it's happening a little bit better. All right. You mentioned Vietnam. I don't know if this goes into that same kind of discussion, but VanEck expanded into emerging markets back in the 80s and 90s. That seems early to me, right? Earlier than investors at large were really ready to look at emerging markets. What was that pivot about?
It was just the rise of China.
Okay.
And sometimes, it's how do you get a sense for these trends happening?
Yeah.
I actually like to travel a lot. I was in Hong Kong really for tourist purposes, but I had drinks with some people and they were like, you have no idea what's happening north of the border. And they were basically talking about Deng Xiaoping and the economic reforms. And, so I did a lot more traveling and tried to, confirm that thesis. And it played out. And back then, I mean, there were they called them Asia funds.
Right.
And then
I remember.
that includes Japan because Japan was a power. And then Asia ex Japan. And then they created emerging markets as the asset class. So I think, that's why we leveraged into that trend. Again, this big picture view of China used to be one of the largest economies in the world. And if it was just bad economics, communism, right, that sort of trapped that potential, and that was changing.
And then when did you start big into ETFs?
About 20 years ago.
Okay. Which also feels early to me.
Yeah, people say that. I mean, it was clearly to me a tax advantage structure, and there was demand for it. I think we were also a little lucky in two regards. Number one, people always love to trade gold. So people would say, oh, like, ETFs are just trading vehicles. I don't need that. I have a buy and hold philosophy. And we're like, you don't want to buy and hold gold all the time. It's downturns and no fun, So I think we're more open-minded to, actively allocating in and out of something like gold.
But from a business perspective, from just a business management perspective, right? The trend in the industry ended up being full on ETFs, right? Now ETFs basically run the show. And we were actually having a conversation before you got here with one of our producers who shall remain nameless, who has been investing in the same mutual fund for a very, very long time. Now, VanEck offers mutual funds and ETFs. Do mutual funds still have a place forever? Or at some point, does the industry move away from them and maybe they become this like niche asset class or whatever? I'm just watching this happen from an investor standpoint. Who's still buying those besides our producer? Who's still buying mutual funds?
Not many people.
Right.
Not many people.
Right.
Our two biggest client bases are individual investors. Individuals love to look at the internet and see what's happening. Mutual fund that only prices once a day is too boring for them.
Yeah.
I mean, even if they're not trading, they want that information flow of, hey, is it up today because of the Greenland news, or is it down, or all that kind of stuff. So individuals like ETFs. And now financial advisors see that they're better as well because of the tax advantages of deferring it. And you as an investor effectively get to choose, unless it's in the retirement program. If your producer's investment is in a retirement program, mutual funds are great. But otherwise, most investors want to determine when they buy and sell.
Yeah.
And
okay.
you can't,
That's that.
In the mutual fund, you can sometimes
agree.
get tax bills, even if you didn't buy and sell.
That's right. You can get tax bills. There are fees that accrue and occur that, anyway, we had this whole conversation and he knows who he is.
Did you win?
Well, I think you just helped me win. I think after that, I won. Yes. All right, let's talk about your Q1 outlook to sort of wrap this up with a bow and what you're seeing broadly in 2026. So recently you talked about an interview that was with Treasury Secretary Scott Bessent. He laid out his Fed philosophy. And you mentioned earlier that VanEck looks at things like monetary policy and financial markets in that way. Key takeaways from that Bessent interview and maybe your Fed philosophy.
Yeah. Well, as I said, I think investors have a tough job because what's in the headlines can be really a lot of noise and not necessarily what they should be focusing on. And our president has an unbelievable ability to generate be noisy multiple times a day on multiple topics. So what I really focused on coming into the year is how much we already know what's going to happen in terms of the big drivers. We know government spending is not going to change in 2026, right? They did a big bill, midterms are coming up. That's not going to change a lot. I'm optimistic that the federal deficit is falling. So, but we have visibility. As far as monetary policy, Scott Bessent, yes, we get a new Fed chair in May. But he was so clear in this interview. Like sometimes you hear something, and he's obviously the Treasury Secretary, so one of the most important people. And he was so thorough in his explanation of what they were looking for from the Federal Reserve, which is a Fed that's less active. The Fed under Biden and Powell were continuing to buy bonds and interfere in the markets for years after COVID. The economy had well recovered. Housing prices were at all-time highs, and they were buying housing bonds. And Secretary Bessent just really critiqued that.
Let's talk about AI quickly. You have said that you believe the bubble has popped, the AI bubble has popped. What do you mean by that? And are there still opportunities if the bubble has popped?
All right, so there's so much demand for AI that we think there is a lot to be built in terms of data centers for the next 2 years. But a lot of investors were saying, is that investment at too high a rate? Is the stock market vulnerable, right, to overhype of AI? And I mean, we like everyone talked about AI a lot, right?
Yeah.
And my point was in the fourth quarter, some of those vulnerable AI stocks got really hurt. Some of these stocks are down close to 50% in the quarter. So not the Mag 7, but the companies that are more vulnerable to the open AIs, so maybe some of the weaker financing, they were down a lot in Q4. So if you like the overall thesis, that bubble popped, right? There's no way Meta's going to run out of money or Google, right? No one was ever saying that. So those stocks and Bitcoin miners that are pivoting to AI got a lot cheaper. Let's go for it. Like if you like that trend and you're willing to buy the riskier names, right? Like in the old days, small caps used to be the riskier names or gold miner shares, right?
Right.
Then you got a good buying opportunity.
Okay.
And the core, semiconductors, Nvidia, which is like the poster child, I think, for all of this. I mean, that stock has been flat for about 6 months, but its earnings keep growing every quarter. So on a valuation basis or price to earnings basis, it's cheap. It's as cheap as it's been in the last couple of years.
Jan, thank you so much for coming on the show. I think our listeners will really appreciate it. And thank you for giving us your time.
Thank you, Liz.
To learn more about VanEck's ETFs and read Jan's quarterly investment outlook, visit vaneck.com. Okay, some big takeaways from that episode. We started off by talking about gold and Bitcoin, and basically that Jan's take was gold and Bitcoin are complementary, not competitive. I had asked him whether or not there was overlap in those investors, and it sounds like he thinks there are, but that they are still complementary asset classes and will continue to be so going forward, and seems pretty bullish on both. Second big takeaway was about spotting trends, because this is something that Van Eck does really, really well. And the idea that he talked about when things get to extremes and new things are happening and they've gotten to an extreme, that's when you start to realize this could be a new trend that's going to shift the environment entirely, and that's when we want to get ahead of it. And he gave a few examples. There was the private equity and private credit example. He gave examples about some trends that didn't work out the way that they thought they would, but I think it's important for investors to know about the successes and some of the ones that took longer than expected. And then lastly, this is a takeaway that more pertinent for 2026 than anything, is that he would expect as a new Fed chair comes in, that the Fed will be less active, perhaps less active in capital markets, and also less active in cutting rates than maybe we originally thought. So to be continued on a lot of different fronts. It was a fascinating episode. I'm so glad you all tuned in for it. Thank you, and we look forward to bringing you the next episode in a couple weeks. For more from me, read my weekly column in SoFi's newsletter, On the Money, and on the SoFi website, or follow me on X at Liz Thomas Strat. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Sony Podcasts.
Investments are not FDIC insured, are not bank guaranteed, and may lose value. Elizabeth Thomas is a registered representative of SoFi Securities LLC and an investment advisor representative of SoFi Wealth LLC. SoFi Invest is a trade name used by SoFi Wealth LLC and SoFi Securities LLC, offering investment products and services. Robo-investing and advisory services are provided by SoFi Wealth LLC, an SEC-registered investment advisor. Brokerage and self-directed investing products offered through SoFi Securities LLC, member FINRA SIPC. For disclosures on SoFi Invest platforms, visit sofi.com/legal. For a full listing of the fees associated with SoFi Invest, please view our fee schedule.